Let's take a look at this comprehensive variance analysis problem. I'll read it in front of you. Kramer Toy Company manufactures a plastic swimming pool at its East Crest plant. The plant has been experiencing problems as shown by its September contribution format income statement below. Okay, and following my mouse, you can see that they had 15,000 pools sold. They budgeted 495,000. Actually had sales equal to that of 495,000. And in terms of variable expenses, they were slightly ahead in variable expenses, so the contribution margin, of course, was below budget. And the fixed cost didn't change, which is what we would expect, given the nature of fixed costs. So the net operating margin was actually slightly below of what was projected or built into the budget. Okay, then Janet Wilson, who's been appointed the general manager of the East Coast Crest plant, has been given instructions to get things under control. And upon reviewing the plant's income statement, she concluded that a major problem lies in the variable cost of goods sold, and she was provided with the following standard costs per swimming pool. So let me slide this up so we can take a look at that now. Okay, so direct material per pool takes 3.2 pounds at $1.80 per pound, and when we multiply that across, we get $5.76 per pool for direct materials. We get $7.36 for direct labor, based on 0.8 hours of labor required to make a pool at $9.20 an hour. So that's where the $7.36 comes from. And then the variable manufacturing overhead is developed at a standard of 0.5 hours. So it's based on machine hours times $3.10 is the rate per machine hour. So variable manufacturing overhead is $1.55. Therefore, the total standard cost is $14.67 per pool. All right, a little bit more information now. She's determined that September, the plant produced 15,000 pools and incurred the following costs. So I'm reading down here again. She purchased 62,000 pounds of material, cost $1.75. She used 51,000 pounds of material in production, and finished goods and work and inventories are insignificant, so we'll ignore that. Worked 11,800 direct labor hours at a cost of $10.10 per hour, and incurred variable manufacturing costs totaling $19,240 for the month, and a total of 7,400 machine hours were recorded. Okay, it's the company's policy to close all variance to cost of goods sold on a monthly basis. Requirement 1 asks us to compute the following variances for September. And the variances are the direct material price and quantity variance. Okay, now let me show you how I worked this problem. And it's worked ahead of time, but I'll walk you through what I came up with. And I'm going to go back and forth. I'm going between two pages in Excel, but you have it on the screen there in front of you. All right, so what I like to do is lay this out this way. Actual quantity times actual price goes on the left, and standard quantity used at standard price goes on the right. And then we move the values across. And let's tackle direct material variances first. So when we take actual price times quantity, first let's see if we had that information. I've got 62,000 at $1.75 right there. We purchased 62,000 pounds at $1.75. That's where that number and that number comes from, and we just multiply them, right? Take what's in cell A6 times A7. And then, if I have $62,000, I'm going to drop it in this middle area. I call it nowhere's land, the middle area. But we also have to come up with the standard. And did they give us the standard? Yeah, $1.80 per pound. So we're going to drop in the $1.80 there. And we don't know 48,000 yet, but what we do know is that they made 15,000 pools. So what we do is we multiply. Let me just hit the F2, or let me show you with the F2 key, or you can look up here on the formula bar. 15,000 pools times 320. Well, where did $3.20 come from? Or 3.2? And it's 3.2 pounds at a price of $1.80 per pound. So we're multiplying 15,000 pools times 3.2 pounds to come up with the total quantity in pounds that we should have used according to the standard. So we get 48,000 times $1.80. We multiply those two, we come up with 86,400. So you drop this one in first, then you calculate that number, then you multiply. Now, once I have 86,400 and 108, I can make some adjustments here. I can slide over the $1.80 and compute this middle ground. But we have to recognize what is purchased versus what is used in production is two different numbers. So we can't just compare 108 to 86,000 to compute the material variance. Instead, we've got to say, well, which number do we use? All right. And here's what you do. You would use this number right here in the no man's land is what I call it. Actual quantity purchased times standard price. So 62,000 times $1.80 is 111,600. Compare that to the 108,500 of what we actually purchased. Keep in mind this one's at a standard price of $1.80. And that gets you your price variance. But we didn't use all 62,000. We only put 51,000 into production. And I think they told us right here, 51,000. You used 51,000 pounds of material in production. So when I slide back over, with that 51,000, we then need to use that to calculate this variance. Well, how do we do that? What we do is we multiply the $1.80 times the 51,000 units that were used in production to come up with a new nowhere's land or middle ground. So we have 91,800 of what actually was put into production at a standard price. And when we compare that, we're actually calculating the variance between 51,000 units and 48,000. Since we required more material than what the standard called for, it's an unfavorable variance. And we calculate that by comparing the 91,800 to the 86,400. The difference is $5,400. So the total material variance is the sum of the price variance and the quantity variance. Positive price, negative variance leaves us a small negative variance of 2,300. That's our total material variance. All right, that takes care of our price and quantity variance. Requirement 2, I believe, as we slide down here, is calculate the direct labor and efficiency variances. So let me slide up and we'll go through this now. Let me leave it about. Let's leave it about here. We may need some numbers from above. Okay, same thing. Actual on the left, standard on the right. Actual hours times actual rate. Standard hours times standard rate. 11,800 was the actual hours at $10.10, and I think they gave that information to us. 11,800 at $10.10, so that's where it comes from. And then 12,000 at $9.20 is the standard. And where did they give us that information? There's our $9.20 per hour, and it takes 0.8 hours to make a pool. So again, we're going to have to do a little bit of multiplication. 15,000 pools times 0.8 says we should have used 12,000 hours at $9.20 standard rate, meant we should have spent 110,400. Well, this time there's no difference between the labor we purchased and used in production. It all gets used. So we can just move this number, put the 11.8 that came from here, and move the 9.20 that came from here into the middle ground, and then just compute the differences. Essentially you multiply, right? You multiply the hours times the rate, then the hours times the rate in this nowhere's land, which is actual quantity times standard price. And then standard at standard hours at standard rate comes from over here. So when we do that, what do we come up with? 119,000 versus 108. Calculate that difference, and that's the rate variance. And hopefully that makes sense to you because we're using the same quantity, 11,008 times the difference between standard and actual rates. And then 11.8 versus 12,000 at the 9.20 standard rate. Here we're just comparing efficiency. The standard called for 12,000. We actually used 200 hours less, so we have a favorable variance equal to the difference between 110,400 and 108,560. Add the two together, and you come up with the total labor variance.